Welcome to this explainer. Today, we're going on a chronological journey. We're going to walk through a structured four-phase masterclass in wealth building. Money has a funny way of rewarding the exact same decisions over and over again. What we're diving into today are 10 specific decisions that have literally survived recessions, runaway inflation, market bubbles, and full-on crashes. These are just temporary trends. They are foundational moves that simply never fail. Okay, let's dive into this. Here's our roadmap for today. We've got 4 key phases to cover. 1. Protect your financial foundation. 2. Maximize your earning potential. 3. Spend with strategic intention. And 4. Build and preserve true wealth.
Phase 1. Protect your financial foundation. Defensive basics for long-term survival.
You see, money creates freedom long before it creates luxury. And your absolute first step to freedom is surviving the unexpected, like your average $1,000 emergency expense. Which brings us to the true purpose of cash. Now, during a bull market, cash feels kind of lazy, right? But its purpose isn't to make you rich, it's to keep you from becoming poor. When panic hits, people without cash end up putting emergencies on credit cards, charging 25% interest, or they're forced to sell off assets at a total loss. People with a cash buffer, well, they actually have time to think. Even Warren Buffett keeps tens of billions in cash for exactly this reason. So once you're protected, the next temptation is usually trying to pinpoint the perfect moment to invest. But let's look at a pretty sobering number, $143,000. Imagine your goal is to improve your finances by $10,000 this year. If you want to do that purely through investing, assuming a healthy annual return of around 7%, you would need roughly $143,000 already invested just to generate that extra 10 grand before taxes. And this brilliantly illustrates why your savings rate matters so much more than your investment return in the beginning. Generating 10 grand through investments requires a massive portfolio. But saving $10,000, that is entirely within your control right now. It means skipping an expensive vacation, maybe driving your current car for 2 more years, or just cooking at home more often. People sometimes dismiss this as a poor people mentality, but that couldn't be further from the truth. Wealthy people use trusts, tax attorneys, and family offices as literal money-keeping machines, because keeping the money you already have is incredibly powerful. Phase 2. Maximize your earning potential. Strategies to actively increase your income. Now we're moving to the offensive side of the journey. Because here's the hard truth. If your income stays exactly the same for a couple of years, inflation means your lifestyle is actually moving backward. Most of us just hope an annual raise will fix this, but loyalty rarely outpaces the market. Your income has to become an active project. You need to switch jobs, learn a specialized skill, negotiate your salary, or build a side business. But wait, before you spend years grinding away in your current career, you really need to ask yourself this pivotal question. Are the people 10 years ahead of me living the life I want? If the answer is no, it's probably time to leave that low-ceiling career early. Don't spend a decade becoming exceptional at something if it simply isn't worth becoming exceptional at. To figure out if it's actually worth it, you have to look at the 3 ceilings that every profession has. First up, the income ceiling. How much do the absolute top 10% in your field earn? Second, the demand ceiling. Is your industry creating more opportunity than it did 5 years ago, or is it on the decline? And third, the ownership ceiling. Can you eventually own something, like an agency, some equity, or a partnership, or are you permanently going to be trading your hours for a flat wage? Phase 3, spend with strategic intention. The psychology of keeping your money. So the crucial point is, once you start maximizing your income, you absolutely have to know how to keep it. Let's talk about negotiating major purchases. Think about this. If you negotiate a $10,000 raise or $10,000 off a house, the outcome is exactly the same financially. The massive difference? That house discount arrives before taxes. Never accept that major prices are completely fixed. Now, as you make more and buy more, you're going to run into a fascinating yet incredibly dangerous psychological trap called hedonic adaptation. Basically, this is our tendency to return to a relatively stable baseline of happiness after a major event. It is the core reason why lifestyle inflation is such a trap. Every single lifestyle upgrade you buy has a rapid expiration date on the joy it brings you. Let's move to and see how this builds out in the real world. You know what's more exciting than a brand new BMW? A brand new BMW.
You could buy the ultimate penthouse and the fastest sports car today, but the new car smell of that excitement only lasts about 6 months. After that, it completely fades and you're right back to looking for the next big thrill.
As our source material so perfectly states, special becomes standard very quickly. You have to be intensely aware of this. Otherwise, lifestyle inflation will completely consume your newly earned wealth way faster than you can generate it. And that brings us to the cardinal rule of spending. Do not finance depreciation. The faster something loses value, the less willing you should be to borrow money to buy it. A work trick that actively helps you earn a living is vastly different from a luxury SUV that you just bought to impress your neighbors. Paying extra interest for the privilege of owning an asset that is actively becoming cheaper every single day, yeah, that's a very hard game to win.
Phase 4. Build and preserve true wealth, equity, productive assets, and spending rules.
Welcome to the final phase. This is where we transition from just having money to holding long-term generational wealth. Now, what's really interesting about this slide is the clear distinction between appreciating assets and productive assets. Gold, art, rare watches, and even your home, they just sit there, basically hoping someone pays more for them later. But productive assets, like rental properties or dividend companies, they actually pay you cash to own them while they grow in value. This is exactly why the richest 1% own more than half of all business equity in the United States. And speaking of equity, ordinary people negotiate salaries, while the wealthy, they negotiate ownership. True, sudden wealth almost always comes from an equity event. An IPO, an acquisition, stock options vesting. I mean, when tech giants grew into trillion-dollar companies, their employees didn't become millionaires just from their wages. They became millionaires because their compensation was tied to ownership. Securing an equity event can literally equal decades of standard raises.
So, as your wealth grows, you need to understand exactly where your spending money is coming from. Think of it as 3 distinct buckets. First, income. That's the money you earn from working. Second, returns, the money your assets generate. And third, principal, which is the asset itself. University endowments and wealthy families follow a very simple rule to stay wealthy forever. Spend the returns, protect the principal. The portfolio's only job is to keep producing. Let's walk through buying a boat using these 3 buckets. If you buy the boat with this year's bonus, you're using income. If you buy it with the rent collected from your properties, you're using returns. But if you have to sell off part of your investment portfolio to buy it, you are actively destroying your principal. It's the exact same boat, but 3 entirely different financial realities. Which leaves us with one final provocative thought to help you evaluate every major financial decision you make from here on out. Sometimes selling an asset to travel the world or help out your family is absolutely the right move, but you have to be totally honest with yourself about the trade-off. Ask yourself, are you making your portfolio smaller or are you genuinely making your life bigger? Keep that question in mind, apply these 10 moves, and you'll be well on your way to mastering your financial journey. Thanks so much for joining me for this explainer, and keep learning.